Thank you for checking out Fieldman, Rolapp Associates Municipal Market Update for the week of October 17th, 2022. This is our 40th posting. Fieldman, Rolapp Associates is a municipal advisor to government. The Municipal Market Update is an attempt about once a month to give our clients and others who are interested an update on the municipal market from the data and the position that we sit in. And from there, we start off with some housing information or the mortgage interest rates for a 30-year mortgage. And for much of our recordings, this has been at the all-time low, which has made homes more affordable. A portion of the reason why you've seen such an increase in home prices. But if you look to the far right there, you certainly see a ramp up. And really the first week in January of 2022 is when this really started to trend upward. And it really has since then. You can see it kind of had a taper off effect there in that July, August timeframe, but it really has gone up to a significant degree. There's an article on Bloomberg, and it's in the odd lot section. The title is, "Here's How Weird Things Are Getting in the Housing Market." And so it points out, one is affordability has gotten difficult for two reasons. One is you have higher home prices. We've had a significant increase in the last 2 years. But two, now to buy those higher priced homes, interest rates are much higher. So that makes that much more difficult. Then they have, I think they called it the lockdown effect, where you're a homeowner who might otherwise look to move. Their family's grown or other reasons why they are looking for a larger home. They might not do that now because they would then subject themselves to higher interest rates. So almost like an inflation factor that they can avoid if they stay in the home that they already own. And so that has made it so there's less turnover of homes when folks are looking at not subjecting themselves to that. Another thing that is they pointed out is they have this refinanceable index in this article I found very interesting. And it basically shows, like, January of 05, about 35% of the homes could get a benefit, 25 basis point benefit if they refinance. Then with, take it all the way to January 20, that went up to almost 100%. So just a ton of refinancing volume due to low rates at that point in time. But now that chart has dropped down to 0. So there's very few individuals or families who have mortgages that could now refinance and get the benefit of 25 basis points. So that incentive to refinance, which then allows for more spending, but also might prompt someone to move because they can get a new loan to replace their other loan instead of refinancing. That incentive is not there anymore. So very interesting article, worth the read. Another one that was in the market or in the news lately that isn't really related to housing as much is Jamie Dimon, CEO of JP Morgan, really got into the risks of inflation, or I'm sorry, of a recession. And so now that really is much more of a conversation piece than it was before. I think before we're talking inflation, when will it end? How do we make it end? The Fed's making all these moves. And now I'm starting to see more out there in the news about when is the recession coming. And I think Jamie Dimon pointed out some of the global events that also could contribute to that. So now on our next chart, really want to give some perspective on how the U.S. Treasury yield curve has changed. And I referenced that first week in January, and I view that as a turning point. That's really when we stopped talking about inflation being transitory and really started talking about, we think we have inflation coming. There wasn't a whole lot of data to support that at that moment, but definitely a lot of economists were starting to get on the news and talk about inflation. And that green line is a more traditional yield curve. Your 1 year is lower than your 30-year, and that's really the way you would expect things. Now that red line represents as of Friday of last week, and what you're probably noticing is the 1 year has a higher interest rate than the 30-year. So we have an inverted yield curve, and many economists point out that that is a sign of a possible recession on the way. But also in our business makes things a bit challenging when you have such high short-term rates. But look, this chart to me, there's just so much here. One, just a difference in rates, but two, the degree that the shorter term rates have gone up so much more than the longer term rates. If you look at that 30-year, and this picture deal is kind of in a way, but if you look at a 30-year, that's an increase, definitely an increase between those two. And I have a chart coming up here that breaks this out and shows the month-over-month comparison a little bit better, but not nearly as much when you look at the 1 year. So really the short-term rates have gone up to a greater degree than the long-term rates. But this chart really tries to get to the heart of that. Now we're switching from the MMD to, we're switching from the US Treasury to the MMD. And we try to show month-over-month change for that 30-year MMD. And keep in mind, the shorter term rates have moved more dramatically. But even just looking at that 30-year, you can see how this has changed month over month. And I talked about that August timeframe when you saw the mortgage rates come down a little bit. We saw that with our MMD as well. But basically by the end of August, beginning of September, you really saw the MMD go up by 54 basis points. And then last month, so month of September, beginning October 1st, you saw the MMD go up even more. So continuing to see an increase here. And so on that long-term MMD on January 3rd, 2022, it was at 1.5. It is now at 3.84. So quite a big increase. I'll say it one more time. The shorter term rates have gone up to a greater degree. I'm just looking at 30-year here. Now, what does this mean? And kind of how does that look to some historical comparisons? And we take that AAA MMD and we look at it on each of the 30-year maturities that we can look at it for. And then that's what the gray bars represent, the average, or the range, I should say, going back to 2005. And the red line represents as of last Friday. And hopefully what you're noticing is on the shorter term, we are close to the highs. And when you look at the longer term, we're still in the middle to just slightly elevated, not where we are with the shorter term maturities. And kind of what's causing all this, and this is the outflows from municipal bond funds. You can see here this big red line spike was an outflow. If it's red, it's an outflow. If it's green, it's an inflow. And you saw that at the beginning of COVID-19. And then now you've seen quite a bit of outflows along the way. So as long as that continues, there's less demand for bonds, which likely pulls up interest rates. But that's somewhat offsetted by a bit of light supply. And so if you look at the last few weeks, we're a bit below the 2022 year average per week volume. And then you look at 2020 and 21, we're quite a bit below that. And so to some degree, the lack of demand is somewhat mitigated by the lack of supply of bonds to sell to investors. Now, our last chart here, we really focus on the economic data that's coming up. So these are all things to monitor, and should one come in unexpected, then that could lead to changes in interest rates. But I conclude with our municipal advisors listed here. Encourage you to reach out to any one of them with more details. We will also do another posting in November, but we thank you for your time and look forward to posting soon.